What's up everyone? In this video, we're going to be going over one of the most important metrics to look at when analyzing a stock. It's one of the best metrics when it comes down to fundamental analysis in my opinion, and it gives you a really good gauge of whether or not the stock you are trading or investing in is overvalued or undervalued. So let's get right into it. So the metric that we're going to be looking at today is the price to sales ratio. Essentially what this does is it shows you how much you have to pay for every $1 in sales for the company you're buying. And remember, this is just how much you have to pay for every $1 in sales, not revenue. And we're going to explain why this is important in a couple minutes. But basically, we can see a chart of Zoom right here, and we can see back when Zoom was going crazy in 2020, Zoom at one point had a price to sales ratio of 120. Nowadays, Zoom has a price to sales ratio of around 8. Using this metric will be very beneficial in today's current market, but it'll also be very beneficial in the future, and it'll help you avoid a lot of different mistakes that investors clearly made with Zoom and many other stocks over the past 2 years. So basically what we're looking at, this blue line right here represents the price to sales ratio, but I want to give you a good understanding of how this ratio actually works. It is calculated by taking the market cap for the company, you divide that by the past 12 months revenue, okay, and then that gives you the price to sales ratio. So for example, let's say you just had like a very small side hustle, right? And let's say you had a price to sales ratio on that side hustle as 100, right? That means like if your side hustle brought in $1,000 in revenue for the year, it would be given a $100,000 valuation, which is basically what Zoom was trading at back in 2020. The price to sales ratio was actually 120, which was insanely overvalued and way too high. So like, you'll see why this is so important in a couple minutes. So like I said, Zoom, it was trading at a price to sales ratio of 120. This was like the biggest warning signal to not buy this stock at the time, and it ended up being very close to Zoom's all-time high. Another example I want to give is like, let's say you have a small business, right, that brings in $40,000 in revenue. Remember, revenue does not equal profits. Like if you bring in 40 grand, you still might have to pay out 10, 20, maybe $30,000 on top of that for your expenses. It depends on the industry, but still, the point is that like this ratio can give you a really good insight on whether or not a company is overvalued or not. So like let's say we look at, like I said, this $40,000 example. Let's say, this small business is valued with a price to sales ratio of 100. If they brought in $40,000 in revenue for the year, they would have a $4 million valuation. Clearly that doesn't make sense. So like I said, this is basically what was happening with Zoom. But what you can do is whatever company you're looking at, whether it's Zoom, Apple, PayPal, Tesla, any company you want, check out their price to sales ratio. One, historically, like how it's been historically, but also two, how it is relative to other stocks in the industry. So I'm going to show you how to do that in a second, but I also want to show you how to find price to sales ratio for yourself. So what I'm going to do is I'm going to go to finviz.com. I'll pull it up like this. I'll just add it to the thing. So you go to finviz.com, you can type in your ticker symbol. Let's say we went to Ford as an example. You press their ticker symbol, F, and then enter. And if we scroll down, we can see their price to sales right here, which is 0.45. All right, so that's how you check the price to sales ratio. And let's say you wanted to compare Ford's price to sales ratio to the price to sales ratio of GM. You would type in GM. You would see their price to sales ratio is also 0.45. So that's good to know. And then you can check the historic price to sales ratio in many different ways. I prefer using TradingView.com because it's in a pretty easy to see way, and I just like it the best. So you would just add the price to sales ratio onto the bottom by clicking indicators. You just type in PS ratio, and then you can just click it like that. But basically, let's say we went to Ford as an example, like I said, and you're trying to see if Ford is overvalued or undervalued using price to sales. So what you would do is you would first see how their price to sales ratio is right now compared to times in the past. let's say we go to like a max weekly chart, we can see that Ford's price to sales ratio for the most part is pretty average. At some points back in 2008, it was a lot lower. At some point a couple months ago, it was a lot higher. But it's pretty average for the most part. If anything, it's a little bit higher. Basically, the higher this ratio is, historically speaking, shows you how much the market is willing to pay for every $1 in sales. So when this number is higher, it shows that people are expecting, one, a lot of revenue or sales growth in the future, and they're willing to pay more for that because they expect the sales to go up. So basically, the higher this goes, meaning the more the market expects the company's revenue to increase a lot. And you can see the same thing for any other company out there. But once you looked at the price to sales ratio, historically speaking, you want to look at it relatively speaking to other companies in the same industry. So for example, I am not going to compare Ford's price to sales ratio with Apple's price to sales ratio. Like I said, Ford has a price to sales of 0.45 while Apple has a price to sales of 7.16. That does not mean that Apple is overvalued and Ford is undervalued. They're just two completely different businesses. So like for example, like out of every $100 in revenue that Apple brings in, they will take home a much different amount of money that Ford will. We can see Apple's net profit margin is like 26.5%, while Ford's net profit margin is like 13.15%. So they're just completely different businesses. So anyways, let's say we go from Ford to GM. So we can see, let's just do it over here. So Ford price to sales right now around 0.45, 0.46. GM is basically the same thing. So by looking at this metric, you can see that relatively speaking right now, these companies are fairly valued based off of the price to sales metric because historically they're not insanely high, and then relatively speaking, they're basically the same. Now, I do want to stress this. Fundamental analysis is very, I guess you can say complex. It's not complex. It's like there's a lot that goes into it. So just know that using this metric alone will not tell you if a company is overvalued or undervalued. There's a lot more that goes into it, like analyzing the cash flows, the profit margins, the total shares outstanding, like all of that stuff, their revenue over time, their debt, all that stuff. So while price to sales is one of the most useful metrics in my opinion, it doesn't cover the full story. As you know, you can say the same thing about any other metric. Like there's a lot that goes into it, but I do feel that price to sales, that ratio is one of the best ways to avoid giant mistakes in overpaying for companies' revenue. For the most part, if you ever see a company that has a price to sales ratio of 100 or 80 or 75 or something like that, you're going to have to really do your research and ask yourself, is it really worth paying $100 per every $1 in revenue that company is bringing in right now? And when you're asking yourself that question, keep in mind that there's two ways for price to sales ratios to move. Either the company's valuation can go down, or the sales or the revenue can go up. Let's take a look at the Zoom example. We can see when Zoom had a price to sales ratio of over 100, their revenue grew substantially since then. Q3 2020 was when Zoom had their price to sales ratio of 100, and we can see that clearly the revenue grew a lot since then. And then on top of that, the share price fell a lot since then, which in turn made their price to sales ratio go from 120 all the way down to 8. So overall, using price to sales is an extremely beneficial tool because for the most part, if it's ever at like 100 or 80 or anything crazy high like that, you can, for the most part, figure that company is overvalued unless you expect that company to have just ridiculous revenue growth in the future. And then on another note, let's say you have a company that has an extremely low price to sales. I mean, what you could call it, you can say whatever stock you want to, but if you expect that company to grow their revenue substantially and their profit a lot in the future, that can give you an idea that company may be undervalued. So keep that in mind. So I just want to say that again. If you have a company with a relatively and historically low price to sales ratio, and you think that company's revenue and profit will grow a lot in the future, that can give you an idea that that company might be undervalued. So I hope you learned a lot from this video. If you want to dive deeper into fundamental analysis, definitely check out that first link in the description and the comments down below. We just had a giant new update on the stock analysis dashboard. It's an awesome tool when it comes down to anything fundamental analysis. It shows you exactly what's moving the stock's prices. You can see revenue in a very easy and customizable way among many other important fundamental metrics, including price of sales, price of free cash flow, and many other things. You get full access to the company's financial statements on an annualized and quarterly view. You can compare any two stocks against each other and even calculate your own price targets. So thank you guys so much for watching this video. Make sure to check out that first link in the description and the comments down below, and have a great weekend.